Okay, good afternoon, friends. So there's some trouble in my network connection. So we will start. Right. Uh, right. So we are talking about today income tax LKAS 12, and today's session subsection of this unit is current taxes. So let us we discuss the basic concepts of accounting, uh, basic concepts of this LKS, right? Accounting profit. So you know what does mean accounting profit? It's a profit before tax. In simple terms. So we prepare income statement, profit loss account by following Sri Lankan accounting standard, right? But the taxable profit it's something different. When we find the net profit, taxable profit, we have to adapt the amendments of tax authorities in the country. In Sri Lanka, we have to follow number 24th of 2017 Inland Revenue Act. Based on that amendments provisions, we have to calculate profitable taxable profit, right? The taxable profit or loss. Taxable profit is the profit for a period determined in accordance with the rules established by the taxation authorities upon which income tax are payable, right? So the taxable profit is something different from accounting profit. The basic difference between the accounting profit and the taxable profit is the accounting profit. To calculate accounting profit, we follow accounting rules and regulations. We follow accounting rules and regulation. In Sri Lanka, we use Lanka Accounting Standard (LKAS), right? SLFRS. But when we calculate a taxable profit, we have to follow the rules and regulations, the rules established by the government, especially tax authorities, Inland Revenue Department in Sri Lanka. Right? That's a basic difference. All that most of the time, taxable profit and accounting profit differ most of the time. That's why the LKS 12 has introduced to this standard will help to reconcile the deviation between accounting profit and taxable profit. And the tax expense mean income tax payment, no, the tax expense, how much we paid as income to the Department of Inland Revenue as income tax cost is the aggregate amount, total amount included in the determination of profit or loss for the period in respect of current tax and deferred tax. Here, normally tax expense mean income tax, the amount of income tax attributable for the profit during the period. So, for example, if your taxable profit equal to 100,000, the corporate tax equal 30%. Then how much income tax? Tax expense how much? Roughly 100,000 into 30% equal 30,000. So this 30,000 equal tax expense for this period, for the current period, right? Right. The current tax. So there are two different concepts: current tax and deferred tax. Okay, current tax and deferred tax. Say for example, so as you told you earlier, for 100,000 taxable profit, at 30% of income corporate tax, you have to pay 30,000 income tax for this period. For example, in 2021, right? But then another new concept, the most important concept in LKAS 12 is deferred tax. Deferred, for example, for your understanding, you keep in your mind deferred tax mean the future. We forward, right? We forward for the future period, future tax, right? For your understanding purpose, you can keep in your mind deferred tax equal future tax, the tax payable in the future, or the tax claimable in the future, right? So current tax is the amount of income taxes payable in respect of taxable profit for the period, for a period. So that is what uh, taxable profit. What is tax income? Tax income mean here the tax income in, right? If your company make profit, you have to pay income tax. So what about if your company make loss, then the government will give you, right? It is sort of what. Say for example earlier, for 100,000 profit at 30% corporate tax rate, we have to pay 30,000 income tax. And this time company encountered with a loss of 100,000. The corporate tax rate is 30%. Then how much? Negative tax. Negative tax, but how much? 30,000 negative. So if you make profit, you have to pay tax to the government. But now this time you make loss, then government will give you tax. But actually, the government will never give you a tax, right? The whole authority, the collection of tax in hand of the government, right? So you can, at this moment, you can keep in your mind uh, when companies make losses, you can make it as a negative tax, right? If you make profit, we assume it's a profit, positive tax. It is attributable to the government. If a company make losses, the negative tax. It means it's a credit, right? So that amount is called as tax income, not tax expense. It's a tax income, negative tax, right? Tax income. Right. If you have tax expense, the tax will be payable. Tax will be payable by the company. If in case of tax income, it's mean negative tax, you can recover. Recover mean in this instance, if your company make losses, the government will reserve 30,000, right? They will give, how they will give. So for example, in 2022 you make 500,000 as a profit. You made 500,000 as a profit at 30% interest rate, 30% corporate tax. How much you have to pay tax? How much? 100 and how much? 150,000. 150,000. But in the previous year you have encountered loss. Therefore, the tax credit equal 30,000. Therefore, you can deduct this 30,000 from 150,000. Then the next year you have to pay only 120,000 as a tax, right? That is recoverable. You have recovered from the government, right? You can deduct the tax payable, tax expense. In case of loss, if you make loss, you can recover, right? So that is the basic definitions of tax. Right. Now we'll see the recognition of current tax liabilities and current tax assets. There are two things: tax liabilities and tax assets. right? Normally, when we make profit, we have to pay tax. Until we pay the tax, it is become a liability. We have to settle within 12 month period. Therefore, we figure out under current liabilities, right? We have it's a liability. Tax payable is a liability, right? Tax payable liability. But in case of your company make loss, your company make loss, then you have to recover. You have to recover the tax from the government. Then this value will be figured out under current assets. Current assets, right? So now we'll see recognition of current tax liabilities and current tax assets in the balance sheet statement of financial position, right? Current tax for current period, current tax for current period, and prior period, previous period, right? So for example, in 2020, right, for the accounting period 2020, you have make some amount of profit, but you are still not paid. You are not you are not yet paid that tax to the government. That is a tax expense for the previous period. Current period is 2021. Current period is 2021. So actually, in Sri Lankan context, the tax period start from 1st of April to the 1st of April until next year 31st March. For your understanding purpose, I assume a tax period start from 1st of January of the month and it, it will end on 31st December the same year for your understanding purpose, right? Right. The current period, current tax mean, for example, we are in the year 2021. So therefore, it is the tax expense for the year 2021. And prior period, previous periods, tax mean the income tax, the amount of tax attributable for the last year, that is 2020. The current tax for the current period and the prior period shall to the extent unpaid be recognized as a liability, right? So the tax amount for the last year not yet paid, it is until we pay, it is listed under, it is figure under current liabilities. And also for this period we have generated profit, but still we are not paid the income tax. So these figures are figured out under the current liabilities. LKAS or IAS 12 requires any unpaid tax in respect of the current or previous period to be recognized as a liability. It's a liability. And if the amount already paid, in respect of current and previous period exceed the amount due for those period, the excess shall be recognized as an asset, right? For example, uh, the income tax payable is 30,000, but you have paid 50,000, then you have paid an additional amount to the government. So 20,000 we can recognize as uh, asset, current asset. Or in the last period, your company encountered with the loss of 100,000. The corporate tax is 30%. Then you can recover in future from your tax expenses 30,000 until you recover it, that amount it should keep as an asset, deferred tax, right? Deferred tax asset. So the excess tax paid in respect of current period or previous period or what is due should be recognized as an asset. right? So the deferred tax can be an asset or a liability, but most of the time it's coming under current liabilities, right? Let us discuss an illustration. In 2018, Darrington Company had taxable profit 120,000, right? Here we assume 2018 is the current period. 2018, we assume we are in 2018. Taxable profit is 120,000. In the previous year, the last year, 2017, income tax on 2017 profit had been estimated as 30,000. The corporate income tax rate is 30%, right? Uh, we have to understand the scenario. Now we are in 2018, our taxable profit 120,000, and in the last year we estimated our tax expense will be 30,000, right? Calculate calculate tax payable and the charge for 2018 if the tax due on 2017 profit was subsequently agreed with the tax authorities, right? So based on our estimate, we estimated 30,000 for the profit on 2017, but the authorities, in Sri Lankan context, the Department of Inland Revenue estimate that calculated that they have finalized 35,000. The actual amount, the actual amount of tax expense 35,000, but we estimated 30,000, right? Then that's a difference. It's called under provision, right? It's called under provision. And this case D, we have estimated 30,000 for the last year, but the actual amount, the government, the Department of Inland Revenue has estimated the tax expense 25,000 over provision, right? So in case of under provision, we will end up with an asset, sorry, a liability, right? Here in the over provision, we have make for 30,000, but actual figure is 25,000. So we have overestimated. So therefore, over provision. So any under or overpayment are not settled until the following year's tax payment is due, right? So 2017 tax cases will be dealt in 2018, right? 2018. Let's see the answer, right? So first we have to identify the current period tax. Current period means that income tax for year 2018 is how much? Yes, the profit is 120,000. The tax rate is 30%. Therefore, for the tax for the current period is 36,000, right? But in regard to previous year 2017, it was estimated 30,000, but actual amount is 35,000. So we paid less. We make provision less amount. We have to pay additional 5,000, right? The actual amount is 35,000. Our provision is 30,000. So we have to pay additional 5,000 to the government, right? So therefore, how much we have to pay for this period? Here, 36,000 current tax and 5,000 is a under provision, right? Underpayment. So therefore, both together, our company, the Darrington company should pay 41,000 to the government. In the second case, in the second scenario, that is our estimated tax was 30, but actual amount is 25,000. Here, the current tax is above 36,000. How do we get 120 into 30%? 36,000. We estimate 30,000, but actual amount is 25,000. So we made an over provision. So we can deduct this 5,000 from this 36,000, the current tax. Then we have to pay only 31,000, right? So this is the case. Clear? And if you have anything to ask, you can post your question in the chat box, or else you can unmute your mic. You can ask the question, right? And recognition of current tax liabilities and current tax assets. Now let us discuss about tax losses carried back, right? Tax losses, as I told you earlier, in the previous period, we ended with loss. We ended with loss. This year, we ended with profit. Then what we can do is we can set off the previous period tax losses. So we assume that negative tax uh, we assume that negative tax is kind of an asset we can claim later, right? It's mean you make the government as a your creditor, right? The government is due to you, right? Government should pay to you, in other words, but and the real thing is not that. You can't get any money from the government in the word as tax, right? So if the government give you money, that's called grant, not a tax, right? The benefit relating to a tax loss, the tax loss actually is a benefit. That's why we are figure out, yeah, under the current assets. The benefit relating to a tax loss that can be carried back to recover current tax of previous period shall be recognized as an asset. Simple, right? So if you make profit, we have to pay to the government. So therefore, that is liability. If you make loss, you have to get money from the government. Therefore, it is an asset. Actually, you can't get money from the government. What you can do is you can you can credit that tax. You can credit against. You can set off that tax receivable from the government in the future period, right? And when a tax loss is used to recover current tax for a previous period, an entity recognizes the benefit as an asset in the period in which the tax loss occurs. So, for example, in 2020, you end up with a loss of 100,000 with 30% corporate tax. Then your tax asset is 30,000 because you made loss, right? And assume 2020 you make 500,000 as a profit, then at 30% corporate tax you have to pay tax 150,000. But what we can do is instead of paying 150,000 we can claim, right? We can adjust from the previous tax claims. So for example, you can claim 30,000 tax loss from this period. So therefore, 150,000 minus 30,000 equal 120,000. That is current tax paid, right? Because it is probable that the benefit will flow to the entity and the benefit can be reliably measured. So we have studied well under framework. So what is asset? What is liability? So when we can recognize as an asset, if the future benefits expected to inflow and it is reliably measured, then you can list it. You can figure out under the asset. So it meets the current the loss, right? The loss, tax on loss. It can be measurable, and we can get benefit from that loss. So therefore, we can recognize as a uh, asset. The tax loss can be considered as an asset. And LKAS or IAS 12 also requires recognition as an asset of the benefit relating to any tax loss that can be carried back to recover current tax of a previous period. So this is acceptable because it is probable that the benefit will flow to the entity, right? You can get the benefit from of it. And it can be reliably measured. You know exactly how much. So definitely we can recognize as an asset. Right. Now we will move to the another question, illustration. In 2017, previous period, right? In 2017, Aramco paid 50,000 in tax on its profit, right? In 2017, the paid profit 50,000. In 2018, it's a current period, 2018, the company made a tax loss of 24,000, right? In the previous period, we have to pay tax 50,000. Tax liability was 50,000, but this period, the company end up with a loss. A loss means we can get a negative tax value, right? The local tax authority rules allow losses to be carried back to offset against current tax of prior years, right? So the tax rate is 30%. Tax rate is 30%. So finally they are required. So the double entries for recognizing a tax charge and the liability of 2018. So in summary, in 2018, it's a previous period, they have made a 50,000, they have made a profit, they are on that profit, they have to pay tax 50,000. And this period, they are ended up with a loss of 24,000, right? The government is allowed to set off any losses on tax losses. The corporate tax rate is 30%. What we have to do? We have to make a double entry. So before we make double entry, we have to know what we have to do, right? So this 25,000 is a profit. The corporate tax is 30%. This 24,000 is not a tax payment. It's a loss, right? Taxable loss, 24,000. Tax rate is 30%. Then how much tax credit? Tax loss how much? 34,000 into 30% equal 7,000. This 7,000 we have to keep as an asset. We have to keep as an asset, right? We have to keep an asset under current assets. Yes, you'll see the double entry. The tax repayment due on tax loss equals 7,200, right? That's 24,000 into 30%, actually 7,200. The double entry will be the debit side, tax receivable, tax receivable, statement of financial position. This means balance sheet, debit side, debit. This means an asset. It is an asset, and the tax repayment, and it's income. It's kind of income. If it's a tax expense, it's an expense. But the tax asset, the negative tax in opposite side, they are in the income statement, right? So tax repayment, 7,200. So the tax receivable will be shown as an asset until repayment is received from the tax authorities. So we are not received any money from them, from the authorities. What we can do is, but they allow us, we can claim, we can recover the tax payable, right? And right, measurement of current tax liabilities and current tax assets. Measurement of current assets, current measurement of current tax liabilities and current assets. A measurement of current tax liabilities. Most of the time we talk about current tax liability, right? So tax assets occurs very rarely, right? Many companies make profit. So when companies make profit, the company should pay tax, tax payable. So if tax payable always coming under the tax liabilities, right? So all the times we call as tax liabilities. Measurement of current tax liabilities for the current and previous period is very simple, right? So they are measured at the amount expected to be paid to the tax authorities, right? So it can be precisely measured how to pay. So how much you have to pay, right? They are measured at the amount expected to be paid to the tax authorities. In case of tax losses, we consider as a current tax asset in case of loss. So it can be recovered. In case of current tax liabilities, and we have to pay. In case of current tax assets, we have to recover, right? We have to recover. It can be claimable. Right. Now we'll see the recognition of current tax. Recognition of current, how do we recognize uh, the current tax in the income state, not income statement, statement of financial position, balance sheet. Normally, current tax is recognized as income. Current tax is recognized as income or expense and included in the net profit or loss account for the period, right? So the current tax. So if you make profit, you have to pay to the government. So therefore, uh, it is what? It is an expense, right? If you make loss, so government will give you an assets. It's an income. Tax arise, so right, but you can't recognize current tax in the following two circumstances. Number one, the tax arising from business combinations. Business combination, you know that merge and acquisition and subsidiary, the holding company purchase subsidiary company, joint ventures, associate. So that kind of event, there are some uh, sort of tax will arise. So yeah, this LKAS 12 does not recognize that sort of taxes in case of business combinations. The tax arising from a business combination is treated differently. Tax assets or liabilities of the acquired subsidiary will form a part of goodwill calculation. So when you study consolidated financial statement, you will calculate goodwill. At that moment, you can recognize this kind of taxes. Second circumstance, a tax arising from the transactions or event which is recognized directly in equity. So that also will not be considered. And how do we present? How do we present that tax expenses and tax liabilities in income statement and balance sheet, statement of financial position, right? So in the statement of financial position, as in balance sheet, tax assets and liabilities should be shown separately from other assets and liabilities. So when you look at the balance sheet, most of the time you observe deferred tax liability, deferred tax under the liability or under current assets in case of deferred tax assets. All right, they have to separately disclose this amount of uh, tax assets or liabilities are there. Current tax assets and liabilities can be offset. So at the time you can't keep current liabilities and sorry you can't keep deferred tax assets, deferred tax liabilities, right? You can't have at a time, right? So you can show either current deferred tax asset or deferred tax liability. So current tax assets and liabilities can be offset, but this should happen only when certain conditions apply. The entity has a legally enforceable right to set off the recognized amount, and the entity intends to settle the amount on net basis or to realize the asset and settle the liability at the same time. And tax expense, when you make profit, that time tax expense will occur. In case of loss, tax income will arise. Most of the time we will focus on tax expense. The tax expense related to the profit or loss from ordinary activities, from the operations, should be shown in the statement of profit or loss. It's a routine activity, operations of the business. And we will continue in the next session. That session is about deferred tax, right? If you have anything to ask, you can uh, post your question in chat box, or you can unmute your mic, you can ask.